All right, let's get right into it. Today, we're taking a close look at one of the most anticipated IPOs in a long time, Lenskart. Now, there's a ton of hype, for sure, but there's also a lot of debate. So, let's dive in and really see what the numbers are telling us.
And right away, this is the main issue, the central conflict. On one hand, you've got this incredible startup success story, a company that has totally changed the game for eyewear in India. But on the other hand, the one question every single investor is asking is the stock just too expensive?
Before we jump into the whole valuation battle, let's just set the stage. Who are we talking about here? Lenskart isn't just some retailer. They're a true giant with a really clear vision for the Indian market.
And the scale we're talking about is just immense. I mean, when you look at the sheer volume of glasses they sell, Lenskart is #1 in the organized space in India and #2 in all of Asia. That's the kind of market leadership that makes investors sit up and really pay attention.
So, let's start with the bull case, right? The good stuff. Why are so many people so genuinely excited about this IPO? What's the story that's getting everyone so optimistic?
Well, it all starts with this number, the one that grabbed all the headlines, a reported profit of 297 crore rupees. You see, for a company that's been all about high-speed growth for years, actually hitting this level of profitability, that's a huge milestone. It's a massive signal to investors. And that profit number isn't just a fluke. It is built on the back of some seriously explosive and sustained expansion. We are looking at a compound annual growth rate of nearly 34%. That is just phenomenal, consistent, powerful growth. And that right there is the engine behind the entire bull case.
And this growth is built on a really solid foundation. I mean, Lenskart has an incredibly powerful brand, right? They've also got this brilliant omnichannel model, which just means their online and physical stores work together perfectly. And maybe most importantly, they have this integrated supply chain. They control the whole shebang, from manufacturing all the way to delivery.
So, with a story like that, it sounds like a complete slam dunk, doesn't it? A profitable, high-growth market leader. What could possibly be wrong? Well, not so fast. This is exactly where the story gets a whole lot more complicated.
And that complication has one big name: valuation. The single biggest argument against this IPO is that the asking price, well, it might be totally disconnected from the company's reality today.
Here it is. This is the number that's causing all the heartburn. A price-to-earnings ratio of over 200. Now, to put that in perspective for you, most solid, stable companies trade at a PE of maybe 20 to 30. Even other red-hot tech companies that went public in India recently were often way below a PE of 100. A valuation this high, it isn't just optimistic. It's basically pricing in decades of perfect performance right from day one.
But here's the kicker. Even that astronomical PE ratio might be too optimistic. Why? Because that headline profit of 297 crores, it actually included a one-time non-cash accounting gain. So if you strip that out to see what the real core business is doing, the normalized profit is way lower, closer to 130 crores. And that makes an already steep valuation look almost vertical.
And the concerns, they don't just stop with the price tag. Let's peel back another layer and look at some of the other potential cracks in the foundation that investors are definitely keeping a close eye on. Okay, two big ones really stand out. First, a huge amount of their raw materials comes from China. That creates potential geopolitical risks, supply chain risks, you get the picture. Second, a large part of this IPO is something called an offer for sale, or OFS. Now, what that means is that a lot of the money being raised isn't going back into the company to fuel more growth. Instead, it's going right into the pockets of the early investors and founders who are cashing out their shares.
And this chart just brilliantly illustrates the world Lenskart is operating in. Yeah, sure, they dominate the organized sector, the branded stores. But look at that. A massive 70% of India's entire eyewear market is still unorganized. We're talking small, local shops. And that is a fragmented, super price-sensitive space that presents a totally different kind of challenge.
So you've got these really strong arguments on both sides of the fence. So how should you think about it? Well, it really just comes down to what kind of investor you are and what you're actually looking for.
You can pretty much break it down into two camps. On one side, you have the long-term believer. They see the incredible growth, and they're betting that Lenskart is going to keep crushing it for years, and eventually the company will grow into this high price. They might even wait for a price dip after the IPO to buy in. Then, on the other side, you have the short-term trader. They're more cautious. They're worried that the super high valuation just doesn't leave any room for a quick profit on listing day. They're probably watching things like the gray market premium to see what the initial demand looks like, but that high price is a major hurdle for them.
You know, this quote from the analysis just sums up the entire dilemma perfectly. It's the classic investor trade-off. A fantastic, innovative business with a huge runway for growth versus the very, very high price you're being asked to pay to own a piece of it.
And that brings us to our final question for you. This isn't just about Lenskart, is it? It's really about a fundamental investment philosophy. When you're faced with this choice, a stellar growth story on one hand and a cautious, maybe even scary, valuation on the other, which side are you on?